Yeah, I mean, let's take a look at the results here. An adjusted loss per share of 2 yuan and 67 cents. That's more than what the street had been expecting of 2 yuan and 53 cents. And when you look to the future, this current quarter, revenues and delivery numbers are lower than what the street expects. So that adds up to a kind of grim year, these set of quarters that NIO has been putting investors through, which is worse than expected and missing on the expectations. And this is an Chinese EV startup which is still yet to make money.
Opportunity, resilience, and innovation. NIO has recently made headlines by securing a whopping 3 billion yuan fund despite facing tough market conditions. This fund holds massive significance as it paves the way for exploring cutting-edge technologies in both the automotive and energy sectors. With insights from the managing partner shedding light on the fund's objectives and NIO Capital's track record in the Chinese automotive industry, we can't help but wonder, how will this substantial investment propel NIO's innovations forward? Let's be honest, when it comes to the electric vehicle game, NIO isn't exactly leading the pack. Ranking 9th in market share in China and facing disappointing third-quarter sales, it's clear NIO isn't the biggest or the best in the EV market. However, it's not a lost cause either. Despite relying on government support, there are reasons for cautious optimism. NIO's sales are indeed growing, albeit slower than expected. With an innovative battery swap business and strategic agreements with major players like JAC Group and Geely, NIO is making moves to stay competitive. Plus, its loyal customer base and strong brand image in China provide a solid foundation.
Yes, ADRs were ultimately up. The signal from William Li saying that they will do more cost cutting, and they've already done a fair amount of cost cutting with the job cuts. 10% of job cuts already put through. Whether we'll see more, we'll have to wait and see. They've also, got their own independent manufacturing license, and this is also key for them to take control of its own production.
In January alone, NIO reported an 18% year-over-year increase in deliveries, totaling over 160,000 vehicles in 2023. Despite challenges, NIO is actively improving its financial performance and operational efficiency. With plans to expand into new markets like Europe and increase production capacity, there's potential for growth. However, it's essential to acknowledge the realities NIO faces. Fierce EV competition in China, industry-wide price cuts, and slowing sales growth are significant challenges. While NIO has its strengths, it's not immune to market pressures. But the good news is, NIO isn't facing its challenges alone. In a fiercely competitive market where profitability is elusive, it's up against heavy hitters like Tesla and BYD vying for dominance in China. Plus, its reliance on government subsidies adds another layer of uncertainty. However, recent cash injections from the United Arab Emirates Sovereign Investment Fund CYVN Holdings, totaling $3.2 billion, provide a lifeline. Despite geopolitical tensions affecting its U.S. market entry plans, NIO remains committed to expansion, focusing on entering the European market. But here's where things get dicey. Without ongoing government support, NIO risks facing liquidity issues or even defaulting on its debt obligations. With reported losses of $2 billion in 2022 and negative free cash flow, Wall Street forecasts further losses in 2023. Moreover, NIO's recent delivery numbers paint a concerning picture, with a significant drop in January deliveries compared to December. Competitors like Li Auto and Xpeng are also experiencing declines, signaling broader challenges in the EV market. And it's not just competition from other EVs NIO has to worry about. The rise of hybrid vehicles, particularly in the US market, poses a threat as drivers seek alternatives to all-battery EVs for reliability. Now, I know you're here to know about NIO Capital's recent fundraising milestone, and let me tell you, it's a big deal. Despite global economic challenges, they've managed to secure over 3 billion renminbi, which is approximately $416.8 million for a new China-focused fund. This move is crucial because it allows NIO Capital to delve deeper into innovative technologies in the automotive and energy sectors. What's really impressive is the caliber of companies they've been backing. From battery material manufacturers like Ranbei to self-driving car startups like Momenta and Pony.ai, NIO Capital has nurtured some of the brightest stars in the Chinese automotive industry. And with ties to venture capital funds set up by regional governments, national funds, and family offices, they're showing serious strength in their network. Speaking to Chinese reporters, a NIO Capital representative emphasized the fund's independence from NIO in decision-making. This flexibility is key, allowing them to explore opportunities beyond just supplying parts to NIO vehicles. It's a testament to their open-minded approach to investment. Now, let's talk context. This fundraising milestone comes when global private investment faces challenges, with fundraising totals expected to drop by 28% in 2023 compared to the previous year. In China alone, private capital funds raised 1.35 trillion renminbi in the first 9 months of 2023, reflecting a slight decline from the previous year. But what is NIO doing to tackle these challenges head-on? Well, they're gearing up for a significant update in March, introducing new variants with shorter ranges for their existing models. This move comes as NIO faces stiff competition in the Chinese EV market, with larger players like Tesla and BYD driving price wars. NIO is strategically adjusting its battery options to adapt to changing market dynamics. While retaining capacities ranging from 70 kWh to 150 kWh, they're introducing new options with significantly lower ranges. These include 70 kWh and 75 kWh packs for standard range options and a 100 kWh pack for long-range capabilities. This adjustment in battery options aims to lower both range and price, potentially reducing the barrier to purchase and expanding sales. By offering battery packs with a 50 kWh capacity, termed City Class range, derived from standard range packs, NIO aims to cater to a wider range of customers without causing dissatisfaction among existing ones. Despite a challenging January that saw NIO's stock decline by 38%, the company delivered over 10,000 vehicles, reflecting an 18.21% increase from the previous year. While intense competition and market conditions have impacted stock prices, NIO, XPeng, and Li Auto reported record deliveries in December 2023. But before we move on, we just want to thank you for watching this far. Another question we should ponder is the trajectory of NIO stock, which has experienced a significant downturn of 90% since early 2021, contrasting sharply with the S&P 500's 30% increase over the same period. This decline has been consistent over the last 3 years, with NIO underperforming the broader market each year. Even renowned companies like Google, Tesla, and Microsoft have struggled to consistently beat the S&P 500 in recent years. In contrast, the Trefis high-quality portfolio, comprising 30 stocks, has outperformed the S&P 500 annually during this period. What makes this portfolio different? It seems that HQ portfolio stocks deliver superior returns with lower risk as a group, which is evident from their performance metrics. Considering the current macroeconomic uncertainties, including high oil prices and elevated interest rates, there's apprehension regarding NIO's potential to repeat its underperformance in the next 12 months. This concern stems from global EV demand worries, particularly as mainstream automakers report softer than expected uptake. While competition intensifies, NIO faces challenges such as price wars impacting its margins. However, there are bright spots for NIO. The company shows progress in battery technology and battery swapping partnerships, with successful tests of a new electric vehicle battery boasting a 1,000-kilometer range. NIO's expansion into the lower end of the market with sub-brands like Alps and its plans to build a battery swap network across China indicate strategic diversification. Despite its challenges, NIO trades at a relatively low multiple of under 1.3x estimated 2023 revenues, presenting an attractive valuation compared to other EV players. This suggests that while caution is warranted, outright dismissal of NIO may not be prudent. Investors should consider maintaining a small stake in the company's high-risk segment, ensuring continued observation of its progress while mitigating potential losses. While NIO's position in the competitive EV market is nuanced, there's potential for growth, albeit with associated risks. So, will NIO navigate these challenges and emerge stronger, or will it falter in the face of mounting competition and market uncertainties? Share your thoughts in the comments section below. And that's it. Make sure to smash the like and subscribe buttons down below. Additionally, if you want to know more about NIO's economic challenges, just click this video right here. Thank you for tuning in, and stay tuned for more exciting content in the future.